latest webinar. Today we're talking specialist mortgages with Kris Pedlar, Key Accounts Manager from United Trust Bank. The key with these webinars is interaction. So you'll see at the bottom of your screen there is a Q&A box. If you do have any questions, please click on that box, pop your question in there, and we will endeavour to answer all of the questions at the end. If we don't get time to cover all of them, we will respond back to you individually, but please use that Q&A and we will come back to you with any questions. So my name is Kris Corns. I am Operations Director here at Crystal Specialist Finance. A little bit about Crystal. We specialise in specialist finance, so bridging buy-to-let, commercial, development, seconds and residential. We are dedicated to the intermediary and service is our key driving point. We are a multi-award winning business and we've got over 40 years in business, and there's some metrics there, over 80 lenders on panel, etc. We are multi-award winning and we were delighted to be awarded a number of awards so far this year already. Commercial Finance Specialist Distributor of the Year, Short-Term Broker of the Year, Best Broker for Commercial and Best Broker for Development Finance at the recent SFIs as well. And as we are dedicated to the intermediary, we understand what it's like going through these times at the moment. So we are pushing our health and wellbeing campaign. So you'll see the hashtag there across all of our social media, Crystal Solve Stress. So we've done a number of questionnaires, we've done a number of investigations into what people's attitudes are, how much sleep people are getting, what their focus is like, etc. So there's some articles that have gone out recently in the trade press, so certainly have a look at those. And we are also running a campaign. So if you send a case in that completes before the end of the year, then you get one of those unique stress-relieving amethyst crystal gifts. Again, you may have seen some of those on social media. So certainly get your cases in, let's get them completed, and we can send one of those out to you. So again, looking at the times we're in at the moment, technology is becoming more and more useful for everyone. We're doing this via Zoom at the moment, which is something probably most people are familiar with now and use it maybe in their daily or weekly lives, whereas prior to this, it's something that was very rarely used. So we're now offering these webinars. We're offering video calls where you can have the benefits of seeing the whites of a BDM's eyes without necessarily having to get too close to them. You can register for updates via our email portals, or you can use our website to get a call back. These times are about adapting, accepting what's happening, adapting to it and working through it. So there are fewer opportunities out there. On one hand, we've got now LTV restrictions from a number of lenders, especially at the higher end of the market. And we've got income issues with the issues with furlough, with the rising unemployment. And again, looking at individual job types, jobs that are heavily reliant on commission, for example, lenders are looking at in more detail. For borrowers that were reliant on hospitality income, pub workers, restaurant workers, things like that. Again, how is their income going to be looked at? However, on the flip side, there are opportunities out there. Stamp duty holiday, which we'll come on to shortly. We've got refinance opportunities. People still need to remortgage their properties if the products are coming to an end. And then because of the speed, again, which we'll come on to in a moment, bridging, capital raising and second charges are now much more popular than we've seen in recent times. So specialist finance has many solutions there that can be explored in order to solve problems. And that's the key thing about specialist finance. It's solving a problem. However, one problem we all face at the moment is speed. It's the time of a case. There's not a huge amount that you or I can do about lender timescales. They are all inundated, most of them are inundated with cases, which then has an impact on service on the back end. But there are things that we can do to help our case move quickly. So from our point of view, ensure that as much information is provided to us under the lender as possible. What we don't want to keep doing is keep picking away at a point or keep having to clarify the same point over and over again. So let's make sure that that's nice and clear. Provide any relevant documentation. If we ask for something, it's because the lender needs it or we need it for compliance purposes. We don't ask for things just because we want to make our files thicker. So if we do ask for something, please provide it and please provide it in full to the lender requirements. Key one is to manage expectations. Lenders are taking longer, solicitors are taking longer, valuers are taking longer. Therefore, if people need to complete in a couple of days, then it could be possible, but it will come with a different product, which comes with different pricing. So again, it's just balancing up those expectations. And although it's called specialist finance, the process isn't really that different to what you're used to. So therefore, when you are meeting with your client, ask them questions, do your fact find, obtain your ID documents and things that you would normally do. They would all be needed at some point during the process. So it's certainly worth getting them in one go. And finally, there, it speaks for itself, but be quick to provide further information. You would be shocked at, or you may not, dependent on how it works, at how many times we ask for an item on an urgent completion and it can take a week for that item to come in. If people need to complete quickly, we need that flow of information and that flow of documentation to be swift, smooth. So we can help because customers have more diverse needs now than they ever have before. And if you're not considering specialist finance, you might be declining cases or trying to shoehorn cases in that just simply aren't going to fit. So for example, think about what your high street lenders won't do. So adverse credit, when we're talking CCJs, defaults, bankruptcy, etc. Complex income situations, in multiple jobs, part self-employed, newly self-employed, contractors, things of that nature. Customers lacking in experience, and they may only have been employed, especially in these times, they may only have been employed in a job for a certain amount of time, or newly self-employed for a certain amount of time. Again, think about furlough, think about payment holidays. All of these things now throw additional ingredients in the mix that need to be considered. Expats, foreign nationals looking for buy-to-lets, or even borrowers getting closer to their retirement age. You only have to look at the demographics of the UK. You can see people are living longer, working longer than they ever needed to before. So you could end up with a situation where you're playing guess who, where you end up with, well, where's everyone gone? Which lenders are left for me to place these deals with? And working with a specialist like Crystal, we can help you with all of those client types. We can help you write more of that business and keep more of those clients. And don't just take our word for it. Specialist demand is growing. There was an article published in the FT Advisor where mortgage brokers were urged to diversify in the wake of COVID. And it quoted a number of mortgage brokers, but it also quoted Rob Barnard from Masthaven, who predicted a change in demand for specialist lenders. And he points out there, lots of people's circumstances have been affected by the crisis. Think about small business owners, self-employed, people who've been furloughed, take a payment holiday. All of these are now prospective customers for specialist lenders. And specialist lending certainly does pay as well. Average commission on bridging loan, assuming a 200k loan, £3,000. Buy-to-let mortgages, typically we're paying out about £1,500. Development finance, 3.5. So they're certainly bigger than the 0.2, 0.3 product transfers that the industry has been surviving off for a number of years. And specialist finance covers a number of different facets, as we touched on very briefly earlier. So bridging loans. So very basically there, bridging 101, it's a short-term loan, typically arranged quicker than a normal mortgage. They are very short-term. The lenders typically look at up to 12 months, although some will look at 18 months to 24 months. And they are very versatile. They fix a problem on a transaction. So when we're looking at the most common reasons for bridging finance, investment purchases. So you're buying a buy-to-let property, possibly maybe undervalued or maybe in need of a refurb, or quickly even. Secondly, there you've got rebridging. Customers that took a bridge 6, 9, 12 months ago that maybe haven't been able to facilitate their exit due to, lockdown preventing the works taking place or the property being on the market for a substantial period of time. Business purposes, so raising money is second charge money on property or on the business premises itself in order to invest within that business to enable it to grow or to meet orders or to order stock. And then 10% refurbishment, 10% chain breaks. Chain breaks are probably the most common one that we're seeing at the moment, where you need to purchase a property quickly before one's sold. Chain break is brilliant for that. It can be secured on one, both, however it needs to work in order to get the loan amount the client needs, paid off then with the sale of property one. And then other areas there, you've got unregulated, you've got auctions, you've got other. It can be used for literally any legal purpose. So it's certainly worth looking at. And when we're talking about speed, we published some articles recently where we did 3 or 4 day completions on bridging loans, which are still possible. These were cases last week, 2 weeks ago. So the Sunday Times published a story maybe a week or so back saying that the average amount of days from offer to exchange in 2020 is 125 days. 23% of mortgage sales of property sales have fallen through this year so far. And they were quoting 19 days to wait for an initial underwrite of a mortgage application. So again, if something is time sensitive, if something needs to happen quickly, not only are specialist lenders quicker, but also bridging lenders are much quicker as well. And again, when we're looking at timescales, 125 days to complete, to exchange, in certain areas. Stamp duty holiday runs until the 31st of March next year. So anyone buying a residential home will pay no stamp duty on a property worth less than 500,000. However, if you're buying a second home, a buy-to-let or anything like that, then the surcharge still applies, but the initial stamp duty doesn't, so you only pay 3%. So take there a £499,000 property, the stamp duty bill's halved. So you now only pay 15 instead of nearly 30,000. So it's a brilliant time, not only for residential purchases, but also for buy-to-let investors to add to their portfolios as well. And some scenarios where that's happened. So we did a regulated bridge to settle a divorce, rate at 0.68. Exit strategy comes from sale from the farmland that wasn't offered as security. Below market value bridge, yes, they do still exist. 75% of the purchase price, 65% of the value, rate of 0.89%. That came in on a Monday, valued Wednesday, paid out on Friday. So again, excellent transaction. We can get up to 90%, possibly even 100% of the purchase price, subject to it being a true undervalued deal. Debt consolidation. Client needed to raise some money while the property was sold. It was marketed pre-COVID. The client had got heavy credit card debts, which were severely affecting their credit and their ability to finance themselves each month. So we did a bridge on that property while the property sold. The client then saved money on a monthly basis. Rate was 0.68 a month, but the interest was rolled up, which was the key, which meant the cash flow pressures the client was facing were over, basically, until that property sold. And there, a foreign national client needed to pay off a highly geared development finance loan. Sales on the site were slow due to both Brexit and COVID-19. Funds were facilitated quickly, and we had a very strict deadline in order to hit that. So it can be done, and they can be used for various different purposes, as you can see. So moving on to commercial. A commercial property mortgage is basically a long-term loan secured on a commercial property. It doesn't necessarily have to be a factory or a shop or anything like that. It can be absolutely anything that they're doing. And where we're seeing a real big growth area at the moment is semi-commercial. So maybe a retail unit on the ground floor with 1, 2, 3 flats above. These are really appealing to buy-to-let landlords because they're used to the residential element and they get a really good rental return off the commercial element without it stretching them too much. And again, 6-month AST on a flat that rotates twice a year, for example, a 5-year lease on a commercial, there's much, much less work involved. So the key there is that we are experienced in commercial, we understand commercial, so speak to us, let's have a conversation, we'll guide you through the process. You can even refer the client to us if you want to, and we'll deal with them for you on your behalf. And again, bringing it back to current times, the coronavirus business interruption loan scheme or the bounce back loans that clients have had, it doesn't stop them borrowing. Lenders look at them in more detail. So, for example, CBILS loans, or actually both of the loans, they look at the future repayment. So when the client in what we're coming at now, 8, 9 months, 10 months time, when the repayments start, lenders need to factor that into affordability. So it's not free money, although the interest rate is extremely low and there are no fees on there, etc. The clients do have to start making payments at some point. So just to bear in mind, if they do have one of those loans, the lenders will look at the affordability. And again, if they are using it as deposit, we need to know about that very early on in the transaction, because the lenders take different views on it. Some take the view that the loan shouldn't be used for that purpose because it was designed to help the business survive rather than necessarily go and buy other assets. Others look at it as being a business, as a fund to the business that they can then use to keep that business growing. And if adding a property into that business is helping that business grow and develop, then they're okay to look at it. But the key thing there is if there is one, let's have a chat about it as early as we can. So moving on to buy-to-let. Again, you're going to do the majority of buy-to-let yourself. You're going to be dealing with the likes of Halifax, Virgin, etc., the usual suspects. So they're well catered for by the majority of the market. Where we add value are those complex cases. So limited company transactions, HMOs, portfolios, adverse credit. Again, look on the screen there, trading companies, SPVs. It's those unusual type of transactions where we can really add value to you. So a recent study carried out shows that landlords are still fairly ambitious. By their nature, they're entrepreneurial. They want to expand and build their portfolios. So half of landlords have said that COVID has had no impact on their investment plans. 19% of them now intend to increase their portfolios over the next year. This was only 12% in the same study of last year. And a third of landlords see COVID as an opportunity. So landlords are seeing it as a blip rather than a reason to change from their long-term plans. And we've talked for a number of years now about buy-to-let limited company or buy-to-let in individual names. And the key takeaway is that it's not a one-size-fits-all approach. What works for client one might not be appropriate for client two. So, for example, if your client already owns a portfolio, they may be taking a very different approach to someone that's setting up their very first one or looking to buy their first property. The key thing to remember here is that we're not tax advisors. So therefore, it's important to ensure that, first of all, we don't overstep the boundaries and we don't give them tax advice, but we ensure that they do get that correct advice now. What we don't want to happen is the client takes the wrong thing now because it's quicker or easier, or we think there's a better product available, but it's a costly mistake from a tax point of view further down the line. So there are a number of things to consider. So think about the client's current tax position, longer term tax implications and estate planning. The costs then of transferring this into a limited company, which we'll have a look at in a second. The availability and cost of mortgage products, the long-term exit strategy, and what's the primary business plan. Buy-to-let is now considered a business rather than a hobby. So it's important that your clients think through what they're intending to do and take the same advice as if they were looking to set up or buy a new business. So what is their primary business plan? Is it monthly rental income as an additional income stream? Is it property value accumulation for later life? Or is it buy, improve and sell on? Because all of these will have very different needs, different tax requirements, different setups. So it's important to find a good accountant, team up with them and ensure your clients are protected. You wouldn't want an accountant giving mortgage advice to your clients, and most brokers certainly aren't set up to be tax advisors as well. Bringing it buy-to-let back around to the current climate, HMOs have been a very popular area of finance in recent years. They can still be done. Investors are still keen, lenders are still willing. However, two things to bear in mind. One, student lets. Due to the current pandemic, there may now be less demand for student-let accommodation, certainly around the university hubs. So less students might be looking to find places away from home. And demand. So given the difficulties of the current situation, social distancing, rule of six, etc., it's fair to assume that demand for shared properties may be seeing a bit of drop-off in interest for now. So lenders are still looking at the cases, but they are looking now at the longevity of the transaction during this difficult period. So the key thing is, again, let's address it early, let's look at it early, let's discuss it, and let's find the right solution for the problem. So having a quick look at heavy refurb loans. So this could be development, it could be bridging with a heavy refurb element. Bridging becomes development, or when refurb becomes heavy when we're looking at the structural changes, planning permission, new extensions or buildings being added, change of purpose, adding new floors, anything to do with the footprint of that property changing. It doesn't necessarily have to be a spade in the ground or ground up development. And there are many similarities between bridging loans and development finance. They're both short-term options. They can both be used to finance building projects or renovate and refurb. Both need to be repaid once the project has finished, which can either be done through refinance or through sale, depending on what they need to do. Terms, development finance typically runs for a longer period than bridging, and therefore it depends on the type of product. For new build and restoration projects, property development is often the better option because it could be cheaper due to better rates. The proceeds of the loan then are released as required, allowing further savings on interest charges. So again, it really depends on what your client's looking to do as to which option we go for, although both of them are very close. And development finance lenders tend to put much more importance on previous development experience. So if they don't have any, then bridging may be the better option for them. But that's for us to worry about rather than for you. So again, let's have a conversation. It comes back to that transparency and comes back to the same points: understanding your customer, knowing your customer, and understanding that transaction so we can get that right from the start. So moving across to secured loans, basically a second charge secured on a property. These are still really popular. Lenders are being cautious in certain areas, but I know Kris will talk about this more in a second. But there are still some excellent secured loan products available for your customers. Common reasons for second charges include things like deposits for other properties or investment purchases, home improvements, debt consolidation, or if you've had a remortgage decline. Again, as part of the MCOB rules, brokers should be considering a second charge as when they come to do a remortgage to see if it's the better thing for your client to do. So therefore, make sure you are considering all options for your client. Again, it comes back to the specialist finance opportunity we touched at right at the start. Let's make sure that we're not missing something because we're saying it's something that's not in our comfort zone or something we don't do. Residential, again, bread and butter for most of you that are tuning in today, but issues can arise where the high street can't help due to specialist circumstances, and we looked at a number of these earlier. But to add to that, things like new builds, right to buy, self-employed are areas where we can really add value. And again, Kris is going to talk more about specialist mortgages in a second. So, wrapping up for me then, the key thing for us is, as I've touched on a number of times, is that initial contact and that conversation. So you can email us, you can visit our website, you can call us, you can visit our offices, you can tune into any of our webinars or conferences that we do online. You can even video call our BDMs. The key thing for us is that initial interaction. So during that, let's place an inquiry with our new business team. We'll get the pertinent information we need. We can then use that to get you the most competitive, the most relevant product and issue terms. If you're happy with those, then complete the application form and submit the application. At that point, it's all systems go for us. It's processing, it's searches, it's getting that checklist out, it's getting the lender dips. It's really working through the nitty gritty of that case and then getting it funded. And the key thing with Crystal, where we set ourselves apart, is that we work with the solicitors as well. Specialist finance is much more involved at that solicitor stage as well. There's more work to do than there is on a normal transaction. So we don't wash our hands at that point. We then work with the solicitors. We help the solicitors with various bits to get that case fully completed. Only at that point is our job done. Again, you've got our contact details on the screen at the moment. We will be addressing questions throughout the webinar, so please keep them coming in on the Q&A. And I'll now hand over to Kris Pedlar, who will take you through the UTB proposition. Cheers, Kris.
Okay. So thanks, Kris, and thanks everyone for joining us. What I'd like to do is talk to you about United Trust Bank, who we are, the journey so far, the products we offer, and a number of our key highlights. The presentation that I'm going to do will be about 20 minutes long, and to keep you all enticed and hooked in, I'll ask a simple question at the end of the presentation, and the first answer on the chat at the bottom will receive a nice bottle of champagne. So keep listening. Well, first of all, introduce who I am. So I'm the Key Account Manager for Mortgages. I've been with UTB for just over 3 years now as a Key Account Manager for the first and second charges. Prior to that, I was working at a secured loan lender as well for the previous 3 years. Prior to that, I was a mortgage advisor for 10 years. So I'd like to think that I've got a wealth of experience on both the lending side and the broking side as well. So background into UTB. So we've been lending since 1955. 1955, we launched through development and retail deposits, which are still part of the company's offerings. All the monies that we lend is our own funds, which is raised through our customer deposits. In 2010, the bridging proposition was launched to market, which was both regulated and unregulated, with rates from 0.48 currently. If you've got any bridging inquiries, then you can speak to Kris and his team. Just a couple of key areas or key highlights from the bridging. We do AVMs, automated valuations. We've got dual representation, and we do biometric ID as well. So that's just a couple of highlights. In 2011, we launched our asset finance division, which covers hire purchase financing, engineering, all agricultural equipment, raising finance against those. In 2015, we started doing second charge mortgages. Really soft launch with a couple of introducers who were passing us business. Fast forward 5 years to where we are now, and we're currently had our record month last month, which during these uncertain times that we're in, it shows how much or what good that we are doing in the market and how much we are looking after both clients and our brokers through these times. In 2019, we launched our specialist first charge mortgages. We launched the first product we launched was a mini mortgage, which was just us introducing ourselves into the market with clients who had unencumbered properties. Then we launched our remortgage products. Also in the same year, last year, we did launch motor finance, which is HP for cars, motorbikes, taxis, and things like that. Again, that's for our brokers, and that goes into our team in the Bolton office. So fast forward, that brings you up to date really to 2020, where we've launched our interest-only products. Things on the way for the rest of this year. Our decision in principle will be going live next month, which is a massive step for us, where you'll get an automated decision for your first and second charges. It's also got the capability to review all the client's credit that is pulled through by Equifax. And also, if it qualifies for an automated valuation, that will be done instantly as well. So it'll tell you on a remortgage and a second charge if it qualifies, and indeed if it's passed for evaluation online. So the products that we've got, I'll just give you a couple of our USPs. I mean, the first one, that is the main one really, is no credit score. So of course, we're going to look at the client's credit file, we're going to review it, but for clients who've got a low credit score, that's not a factor when we're assessing an application, specifically when clients are looking at, if clients have not got the best credit score because of recent unsecured credit, maybe even mortgage arrears, then that's where we're really prevalent. We'll lend up to the client's 85th birthday. So if any applicant is 70 or above that point of application, then the client will need to get independent legal advice. But apart from that, we will lend up until the 85th birthday. Married in sole lapse. So again, if we've got a husband and wife, but only one name on the deeds, we will do that in just one name. I know a lot of our competitors and other lenders out there will insist on the clients, if they're married, and both names need to go on the deeds. But on the application, but no, we don't need to do that. We can just take one name. Brings you to our prime and near prime products. So we've got three plans. We've got a 0 plan, a 1 status plan, and a 2 status plan. So the 0 plan, no missed payments in the last 12 months, no CCJs or defaults in the last 2 years. Unsecured, we've got a niche in this space. So for our clients who have got current unsecured adverse or currently behind, if they are able pre-submission to bring those accounts up to date and evidence it, then they can go on our best plan. On the 1 and 2 unit plans, it's either 1 missed payment in 12 or 2 missed payments in 12, depending on the plan. And then you can have your CCJs and defaults within that as well. Where we've just changed criteria is around the unsecured arrears or current adverse and unsecured. So we ignore the status of their unsecured items on the 1 and 2 unit plans, as long as we are consolidating them with our loan. So for applicants who are maybe 4 or 5 payments behind on a credit card, as long as we're consolidating, we ignore the amount of payments that they are currently behind. So the products that we offer, fixed rates and interest only. We have got a range of 2, 3 and 5 year fixed rates. The 5 year fixed rates comes with an ERC free and with ERCs as well. Affordability is assessed, from an interest only point of view, affordability is assessed on the interest only payment alone. So a lot of the first charge lenders, they will look at the capital and repayment payment in order to assess affordability, whereas we look at just the interest only payment. Interest only is available on remortgages only, and on purchases up to 75% loan to value. Okay. Loan purpose. So we'll pretty much lend for any legal purpose, to be honest with you. That includes debt console, home improvements, tax bills, paying out a divorce or removing someone off the title deeds. Buy to let, second homes, holiday homes. As I said, any legal purpose we can look to lend for. From an AVM point of view, on a remortgage, we will do an automated valuation up to 75% of the client's property value and up to £250,000 mortgage size. And on a second charge, we will do up to 65%, up to £100,000 loan, and then up to 70% at £50,000. For our mini mortgage product, our unencumbered plan, your clients can have up to £50,000 mortgage size and up to 30% LTV, where we can do the AVM or the free val. All our leading rate on the first charges is 3.8% on a 2-year fixed rate, and the best rate on our second charge product is 3.9. So one of our major USPs is around the property types that we lend to. So we we accept most standard mortgageable property types. That includes concrete, steel frame, high-rise, ex-council flats. Typical examples of this are for clients who are ex-council flats, maybe in London, 20 stories high. A lot of lenders restrict maybe above the 5th floor, but again, we're fine with that. We will go to full, all 20 stories. at full LTV as well. We'll lend above shops, ex-council flats, in the last year of preemption as well. We will lend all to standard LTV bandings. So what we ask is that the property is mortgageable. So if we do need a valuation, the surveyor confirms that the property is mortgageable. The property is traditional to the area, so it's not a massive detached house in a street full of terraces. We're looking for something like that from the surveyor to make comment. And then lastly, we want the property to be habitable and remain habitable. The process, so how you will complete an application with us, you'll pass it through to Crystal, who will enter the application onto our portal. In a couple of weeks' time, they will get an instant decision, which comes back with the plan that is available, whether it's qualified for the AVM, and indeed whether the valuation has been done. Once Crystal have submitted all the documents to us, a case manager will be assigned from UTB. That will be worked within 72 hours, and we will then go back to Crystal with any outstanding requirements. Once all that has gone through, we will then invite your clients to do what we call the UTB Secure Chat Hub, which is our biometric ID. So this, for those of you that know the second charge market, this is replacing the security call or the speed with call. It's where they can download our app, they can verify their ID, and that removes the need to have a physical call with the clients. On a remortgage and second charge, once the offer is issued and sent to the client with the mortgage deed, when the mortgage deed is returned, we will fund that day. There's no waiting for a couple of weeks after the offer has been issued in order for us to complete. We will complete same day as soon as we get that mortgage deed back, with the broker fee and commission being paid to Crystal the same day. So just a couple of case studies that I can run through. I mean, a perfect example of one of our second charge loans is for home improvements, where an unusual property type was identified, an ex-council house with a flat steel roof with concrete construction. Again, from that point of view, if it qualified for the AVM, then fine, we can put that down as a non-standard property, and that's fine. If a surveyor goes out, then again, we're just looking at the things that I said before. It's traditional with the area, it's habitable, and it is mortgageable. Other case studies that we've got, debt consolidation. So again, for an example of someone who has got 3 unsecured commitments, all currently behind by 1 payment at the minute. If your clients are able to bring that up to date and evidence that it's been brought up to date, then we can do that on our zero plan, on our best rate. Okay, and then final case study is looking at a deposit on a buy-to-let. So again, if you're looking at either a remortgage or a second charge where the client's looking to raise X amount of pounds in order to do that, then again, that is something that UTB can do. Okay, I think that brings me to the end of my presentation, and I'd like to bring Kris back where we'll do the Q&A.
Thanks, Kris.
No problem.
Yeah, really interesting presentation there, and I think you've triggered more questions on the Q&A than I did from mine. So brilliant, well done with that. Again, apologies for the technical issues. We're going to share the slides within the next 48 hours with a link that you can rewatch this in full if you want to, along with your CPD certificate as well. I think Kris did really well covering all of that without the benefit of any slides, whereas I cheated and had mine pre-recorded.
Let me just ask my question, Kris. So for the bottle of champagne, what we'll ask is, what is the max LTV we will lend to on interest only? So if Kris is looking at the slides or the chat and see who comes back with the answer. Wow.
One there really quickly in the Q&A.
That was really quick. Do you want to reveal it?
Carry on, over to you.
Okay. So, yep, Andrew Ashton, thank you. 75% is correct. And again, I'm sure Kris will give me your contact details, and I will arrange a bottle of champagne to be sent to you.
Perfect, well done. And lots of answers flying in on that as well. So it proves everyone was paying attention as well, which is even better. So looking at a few of the questions that we've had in then, we cover a few of those off now for you. So a couple there for you at the top then, Kris. Interest only, what repayment strategies are acceptable? Can you do sale of property?
Yes, we can. So for people within the M25 circle, we require £250,000 equity in the property. Outside of the M25, it's just £150,000 of equity as a suitable repayment vehicle for interest-only downsizing.
Thank you. And what levels of adverse are accepted on levels 1 and 2?
Okay, so we'll go with the heaviest plan. So our status 2 plan, you can have 2 defaults or CCJs within the last 12 months. Over 12 months, you can have an unlimited amount, as long as the original balance of the defaults doesn't equate to more than £15,000. Also, you're allowed 2 missed payments in the last 12 on a mortgage, with no missed in the last 3 months. And as we said, with the unsecured, you can have a number of credit cards or loans or unsecured accounts which are currently behind. As long as they're being consolidated with our loan, then we can accept those.
Excellent. And I think the credit one has come up a couple of times as well on some of the registration questions that we've had in.
Okay.
And I think adverse credit is something that a lot of lenders seem to be shying away from. So anything within the last 12 months is something that a lot of lenders shy away from. Whereas I know from your criteria, Kris, that you're much more flexible than some of them when it comes to that. And the rates aren't particularly reflective of the worst of credit situation either.
No, and I think so. The zero plan is our best plan. It's the near prime. It's for customers who've had a blip. But then, like I said, we do cater for the clients who've had a bit more of a blip in the past, especially with on the 1 and 2 unit plan, where the actual number of defaults or CCJs over 12 months is irrelevant. You can have as many as on the credit file. It's just as long as it doesn't go to more than £15,000 original balance that we'll cap it at.
Excellent. Thank you for that. And a little bit about your income multiples. Do you have an income multiple, or do you do it on affordability?
So it's done 3 ways. So we have LTI, DTI, and we also work on affordability as well. Under 60% on a remortgage or on a purchase, we will do 6 times LTI. Above 60%, we'll do 4.5 times. DTI is 40%. We also work within an affordability calculation as well. So when the details are put through the portal, we will calculate the net income. We'll work out ONS in the background, and that'll give us a surplus figure. So it's an LTI, DTI, and a surplus that we're looking for.
Perfect. We've got other lenders on panel there as well that will look at using an affordability model completely without any LTI restrictions. And also bear in mind the pound for pound remortgages as well. There are still lenders that will do a pound for pound remortgage without taking into account income multiples. So for your mortgage prisoners and people like that, if they're not capital raising. When it comes to rates, obviously you touched on your rates there earlier, Kris, 3.8 on the first and 3.9 on the second. So you can see, although it's called specialist and it's called, people look at it as being maybe an alternative product or a different product to what they used to, the rates, they're not anything worse than I think most of us are used to seeing on the standard market.
I don't think so. And I think the products that we've got the purchase, all the products that we've got, whether it be purchase or the remortgage, the 3.8 is the same for both. We've just brought in the 80% plan. So on a remortgage or purchase, we can go up to 80%, and that only came in last week. And we are seeing quite a lot of interest in that product. So everything seems to be going well.
Yeah, brilliant. We had a question just pop up about bonuses. Do you take bonus income into account?
Yeah, we do. So we need an 18-month track record of it. So typically, what we are now, October, so we'd need the client's last 3 month pay slips, and we'd also need the P60 from March, which gives us 18 months worth of history. Enter that into the portal. So Kris will enter that into the portal as the full amount, and we will use 50% of that. And that's 50% for overtime, 50% for commission, 50% for bonuses.
Excellent. Thank you. We had another question come through about PGs, lenders that will proceed. This is more for the commercial side, I'm assuming, or bridging. Will lenders lend without a personal guarantee in place? There are some lenders that will, yes. It depends on the deal itself, and it depends on the reason for the PG. If you've got someone with very low income looking to buy a £5 million property, then obviously the lenders are going to look at that very differently. But if there's a good reason for it and it makes sense, there are lenders out there that will consider lending without a PG in certain circumstances. We had a further question come in on overseas borrowers, a UK company where the directors are resident overseas. Again, yeah, that's a standard specialist deal for us. There's a lot of lenders in the space that will consider those. So again, it's just looking at the security itself. Can we get to the UBO? So can we understand who that ultimate beneficial owner of the company is? And can we get comfortable with who they are? If that's all above board and straightforward, then yes, these deals are quite straightforward for us to do. Any further? Oh yeah, further question on their consumer buy-to-lets.
That's not one for us. that's Kris's space. I think we will be doing buy-to-lets. If it's not by the end of this year, it will be early next year, and that's on first and seconds.
Yeah, perfect. And consumer buy-to-let separately, yes, we've got plenty of lenders on panel that will offer those. A very topical question. This is probably one for you, Kris. Self-employed directors, or self-employed or directors, what additional checks do you do now as a result of COVID?
So what we're looking for is on both sole traders and limited companies now. We're looking at the last 3 months' bank statements, business bank statements. What we're looking for is volumes of income through the business account to be similar to pre-COVID, i.e., what's on the tax returns or what's on the turnover on the accountant certificate that we asked for. So it might well be that they've only been back in work for a full month. That's absolutely fine. We want 3 months bank statements. We'll look at the latest month, and we'll see if the revenue going through the account is similar to the accountant certificate or what they're saying as the turnover, or indeed the profits from the self-assessment. But yeah, normal LTV applies. We'll go to 75% for self-employed.
Excellent. And payment holidays, are you okay with those?
We are. So all we want to see is that the client is out of the payment holiday. So as long as we get confirmation that they are out or they've made the first payment out of the holiday, absolutely fine. And that's, I mean, while we're touching on that, I suppose we can look at furlough as well. So again, furlough, if they have got the first pay slip out of furlough, then that's absolutely fine. We can see that the income is the same as pre-furlough. And if they're not due back or they've got a return to work date, then we'd want something from the employer confirming the date, confirming the salary pre-furlough and post-furlough, just to make sure there's no change.
Excellent. Thank you for that. Well, I think that brings us towards the end of the allocated time slot that we had for this one. So, massive thank you to Kris for the time he's taken today and for the really informative presentation. Again, it's probably triggered the most questions we've seen on these, so certainly keep them coming in. If we haven't addressed any, or you get any further follow-up questions, you can email me if you want to, k.corns@crystalsf.com, or email info@crystalsf.com, and we'll get back to you with anything you've got from there. So again, thank you to everyone for tuning in. We'll get you the slides sent across shortly. We'll get you the CPD confirmation sent across shortly as well. And we hope to see you again on the next one. Thanks
for your time, everyone.